For more, Sonali, of course, for several months now, people have recognized or been of the view that this crisis probably is not a systemic risk for the banks, and this looks like a sort of partial, I guess, all clear from the Fed.
Partial is the right word, Joe, because even though you have buybacks coming back, you still have dividends capped. And the Fed's concerns go into next year. They're still concerned about commercial real estate. There are concerns about any drying up in funding markets as well. You know, we had Seth Carpenter of UBS on with us just this week talking about concerns about the money market also facing some potential hiccups throughout the end of this year into next year. So there are still concerns. You see that in their limitation of the dividends.
Who does this benefit the most, Sonali, these latest unveilings?
Well, the fact that buybacks are coming back, it benefits the banks and it benefits the investors, certainly. Again, to a degree, because there is that dividend cap. However, remember, there's a big concern among politicians still, from many of them. There's concerns among policymakers. Lael Brainard was one of them that had been concerned about all capital distributions at the banks at this time, because capital, they feel, should be used for lending. And there is a lot of concerns that the lending will tighten considerably for small and medium-sized firms that face a tough time into the end of this December and will face a tough time into next year for a while, especially as we see the virus continue to surge.
Was there any sort of sense, though, Sonali, that we saw that tightening? And I mean, in a meaningful way. I mean, obviously, anytime you get a recession, you're going to get a little bit of tightening just to protect against the credit risk. But this wasn't that type of panic that we saw during the financial crisis, where banks just basically say, we're not lending to anyone.
No, that's certainly not the case. And you saw the banks at the beginning of this crisis really step it up and want to be the good guys in this scenario. But with that said, the biggest thing about the Fed, and I talked to Sheila Bair about this for a while, is that we found in this crisis that how underpenetrated the United States is in terms of a banking system, how many areas, how many underserved communities there were that didn't have a bank, let alone have problems accessing the PPP program and other types of emergency facilities. So that was a big concern, and it's especially concern, Romaine, into the second part of this crisis as we see charge-offs start to show. We see more of those issues in real estate as these moratoriums start to roll off, and everyone start to be a little less friendly.
So by and large, of course, all stocks kind of crashed in March, and banks were no exception. But we never, even in early April, middle of April, there never seemed to be major fears of a banking implosion. If you look at other measures of banking system stress, it sort of quieted down pretty quickly. Do people you talk to feel that, okay, this was our first really big episode of economic stress since the financial crisis, and that some of those regulations put in place to make their balance sheet stronger, force banks to hold more capital, have been, in a sense, vindicated and appreciated?
They do say, yes, that the stress tests were really good. I had a banking executive tell me the other day that they think the stress tests were so effective that they believe the tech firms should go through them as well.
Wow.
But on the other hand, I've had a banking executive of a smaller firm count the number of days that they could stay afloat with none of their clients paying them a dime. So that idea that April was just a big save, I think that everybody realizes that it's because of the Fed. And that is a pretty fragile fix in a lot of ways, because how long can it go on for? And when do we start to hit, if we have another big negative shock, any potential liquidity issues would be a big issue.